Hi, good morning, everyone. Hope you all are fine, safe, and healthy. Okay, so basically, I'm going to cover up some points on the basic technical analysis. Okay, uh, honestly, I always believe in the concept of KISS. The KISS concept means keep it straight and simple. Okay, there are a lot of people who do a lot of technical analysis, a lot of detailed charting. There are a lot of studies they put in. There are a lot of things they do it. I keep it very straight and simple. I believe a mere moving averages can also give you a lot of indication of where the market is going to move, and they really can take you, they really can give you a real insight of any stock or particular commodities on how it's going to react to things. So let's just see this. This is just start with a simple thing. I'm not getting into the details of how the moving averages work, what is the moving averages, and all that stuff, because I think everyone knows what is moving averages. So basically, I have a chart and I have my own study wherein I have developed this. I've done a lot of research behind this, and came to a conclusion that how this is going to work. It okay. So we're going to take a few moving averages. If you can see, this is a gold futures chart, okay? And that is the gold futures COMEX first month chart. And this is a 15-minute chart, and I have placed on various moving averages. There's a 200 moving average, there's a 7 moving average, exponential, of course, all. There's a 34 moving average, there's a 50 moving average. And if you can see, there is also an RMO oscillator. Now, this RMO oscillator is available free, which everyone can take it. This is just an indicator to support whether what you are doing is in the right place or no. Okay, I'll try to cover that up. Okay, so basically, we would see now this moving average. Now there are four moving averages that we are taking. Okay, so 200, 7, 34, and 50. Very important two moving averages are 7 and 34. Now, if you see, I'll just try to hide the 200-day and the 50, so it's easier for you guys. Okay, so now this is blue is the 7 moving average, the red is the 34 moving average. I don't need to tell anyone, or I don't need to be, anyone doesn't need to do a rocket science to just understand that what does this mean. Now, if you can see, when the 7 moving average is cutting above the 34 moving average, the commodity price is going little upward. The same happens when here, if it cuts down, it goes down. Now, if you can see here, if I'll just zoom it, see, this is the place where it is not crossed over. So when it's not crossed over, so this is the place when it is crossed over, but then it again came down. So now there is some rules if you want to follow something like this. Okay. So the rule number one is whenever 7 exponential moving average crosses over 34 exponential moving average, it's a buy zone. And whenever the 7 moving average crosses below the 34 moving average, it's a sell zone. But but the question is, what is the price to buy and what is the price to sell? So just a simple example, if I say you, uh, say on this candle, that is a 15 December 715 candle. Okay, the 7 moving average and 34 moving average were the same, so it is not crossed over. If you can see here, okay, on the left side, it will say you both prices are the same, so it's not crossed over yet. Now on this candle, if I say 7 has already crossed over 34, so I will wait for this candle to complete. Once this candle is complete, it will confirm that the 7 has crossed over 34, so I will go to the next candle. But when will I buy? I will buy on the candle in which the crossover happened. I will buy above the high of that. So the high price of this was 1835.20. If you can see upside on the left side, up there is a high that denotes this candle. It's a 15-minute candle basically. So 1835.20. So I will buy only above 1835.20. So I'll wait for the next candle. I'll say, okay, it's still 1835.20. So my buy is still not initiated here. No, it's initiated. So the next candle, it's already 1835.70. I will initiate the buy. So if you can see this 1835.70, is already crossed an high of 1839.10 right now. That is currently going on. So this is a current buy that is open. I've already got a move of around $4, which is a significant if I'm doing a 15-minute candle. Now, if I go back to understand now this, let's take first this. So when this crossover happened, here the crossover didn't happen downwards. Here the crossover happened as the seventh moving average price is lower than the 34 moving average. So the crossover has happened. So now I'll have to sell below the low of this candle. So there is 1828.30. I will have to sell below of this candle. So when the next candle, there is the low has not breached, so there is no sell activated yet. So to 1828.30 is what I'm looking. So this candle. So after one candle, there's a low has been breached, and my sell is activated. Now this has gone down a bit. So if my sell was 1828.30, it's gone down to 1825.40. Not a significant low, but then at least I got a momentum of at least $2, $3. Now, uh, the question is how much is one has to predict the move once it crosses over or crosses below. So this question is something that really you need to answer yourself. Okay. uh, no one here can help you. I can only tell you is that this indicator gives you an indication of the immediate movement. Now there's a very classic example. If I go a bit on the right side, say on this candle. So this 15 December 245 candle, if you see 7 has crossed over 34. Now immediately the next candle is the same and the next candle it has crossed below. So was the buy initiated? No. Why? Because we said that if it's a crossover done, we will buy only about the high price of that candle. This 1832.70 high price was not breached at all. So we will not buy, and my sell is still activated. It's still active basically. So it's not that my buy zone is active. So my buy only happens here. Now we'll just see a few more examples. Now we'll just see this. So this here the buy was activated since the 7th crossed over 34 and at 36, and this got around $6, $7 move. Now I'll go a little behind so you'll understand. So that this is a big zone that happened. Okay. Now if you can see this, it's a classic example now. Okay. So uh there was a crossover down on 12th December at around night 1:15. This crossover, this was not crossed over, this was crossed over. So you have to sell below that. That is 1841.40. Now this one is, if you can see, is that this was not crossed over below. So we were waiting for this to happen 1841.40. This was not breached, not breached, not breached. Now this it came back again to 734, the same price. The levels of the 7 and 34 moving average were the same. So still it was not crossed over up. Okay, so the buy was not done yet. We are still on the sell category. Again, the next candle it breached down and it crossed over down. So now we had sold this at 1841.40. Okay, so this has been crossed over to 1839, and this rally went up to the lowest point of 1820. So we got almost a $20 rally. Okay, so this is just an indicator of what exactly this is. You know what exact move this stock is going to be. Now, this 15-minute chart can give you an early indicator, but for a smaller move. So if you want to earn, say, $1, $2, $5, $3, depends on your risk appetite, you can go for a 15-minute chart. But if you want to go for a little higher move, you can go for 1 hour chart. You can just change over and you can understand by this that once the crossover happens, it moves in the rallies. Once the crossover, now there are always false rallies also. So now in 1 hour chart, this is still not in the buy zone. It is still coming in the buy zone. But if you want a real long move, you go for a daily chart. So once you have the daily chart, you really know what exactly is going on. So now if I see there was a buy on, I'm sorry, this is indicator as well. Okay, So there was a buy on this was this yep. So basically there was a buy on 26th of March. That was just as the pandemic happened, and the buy was 1672, and this buy move, okay, this was not breached. Yes, this was not breached down. So this my move gave me 2089 high. Now you can understand how big a rally we had got here. Now if I see this also, there's a sell here, it went down, but then here, now this is a very classic example and very good example. Now there was a 7 had breached 34 on the upside. It had crossed over up, and we had to buy about 1961.80. The next candle is 1966. So basically, we were on the buy zone in the next candle itself, but it again went down. So this is like a false trade that came in. Okay, so this is typical false trade which we can't avoid. Honestly, there every studies are having some flaws, or you can say there is no 100% profit studies. So you need to be prepared for such kind of losses where you need to define that, okay, I have to cut my stop, I have to go on my stop loss. So where is the stop loss? The stop loss can be either you define your own stop loss, but there is a risk in this, that there's a chance that if this move come down and the next candle again went up, so you would have just hit your stop loss and the indicator was still on the buy zone, and it went ahead and achieved its target. So basically, either stop losses can be whenever there's a crossover again happening on the downside. If you're on the buy and there's a crossover happening on the downside, you can hit the stop loss. If you're on the sell zone, if the crossover happens on the buy on the upside, you can hit the stop loss. So that is a simple strategy stop loss which you can keep. But then yes, something which is little unpredictable is, where will the stop loss be and how much is the target. So this indicator really gives you an upward move that boss the stock will move on one side, either upside or downside. This indicator gives you an idea of the stock has got some momentum on going somewhere. How much is your call? Now we'll understand why we need 200 day and 50. So I'm putting 200 day, putting 50. So now this 200 day and 50 gives us a basic idea of how much is the resistance and support level that is going to happen. Now, at the currently, if you see, the 200 day moving average is at 1805.70, and that's so we can considerably say that 1805 is a very good support level, wherein the 200 day moving average it is there. If the prices even come down, 1805 will be a tough place to break. If it breaks down, there is a very high chance of stock moving or commodity moving downside. Now 50 day is basically a small indicator which supports that, okay, it can go upward downward any side. Now if you can see this case study when we had hit the stop loss, okay, in this indicator we had not reached a 50 day because we just the 7 day moving average was below 34, it was also below 50. But in this indicator which where the crossover happened above 734, the 7 when the 7 crossed over above 34, it also crossed over about 50 at the same time. And then there was a stop loss and it came back down again immediately. So this is where we can have a little bit understanding that, okay, if it is crossing over immediately on 50 and 34 at the same time, there is something wrong. We can always have. Now if you can see here, okay, the 7 has crossed below 34, but it is still not crossed below 50. So there's a considerable sell that you can do it, which even you got a rally, a little rally, but it got a rally at least. So 898 and you got 56. So it's a 40-point rally. See, when you're talking about daily, we don't talk about a $4, $5 rally. We always talk about a $50 or $30, $20 at least minimum rallies. So this is something we need to understand. Now we'll come back to this. Okay, so I'll just put this chart up. Okay, So what is this RMO? Why is this RMO also being part of this study of the moving averages? Now, if you can see, okay, I'll just try to switch off my video so that's easier. Okay, so if you can see now, whenever this now here, okay, when the stock, when the prices, when the seven were crossed below 34, it was a sell zone definitely for us. But in the RMO, it was still under the green. The RMO oscillator said that it's still not on the red zone. So RMO said that here is the red zone when it was almost down. Okay, so RMO basically is a late indicator to give you, but it's a short indicator. So if I see RMO gives me, if RMO is saying me you need to sell below this candle, but then it was, this low was never breached, so the sell was never done. So we were still on the buy side. Now here, RMO gave an early indicator saying that you need to buy about this candle. If we had bought about this candle, we would have got a high of around, say, we would have bought in 1918 and we would have reached 1960. So we got a $50 rally almost, $40 rally. But then our 734 indicator gave us that we should not buy, we should buy only about this, you know, bar. So this candle, I'm sorry. So now it's important that you keep a mix of RMO as well as moving averages, because this will give a clear indicator. Now for here, we already had a sell on the 734. So this sell was saying that you need to sell below 1848. Now 1848 was not breached, but this candle gave, the RMO gave a sell on this also. So we have a double confirmation that the market price is going to go down. So this both, once they have breached, you know the price is going to go down. So then 1848 was, the low was 1767, almost an $80 rally. So this is a novel indicator which can always help you, you know, whether you should go for it or not. Or maybe this is something which an aggressive indicator can, aggressive person can take, you know, either you can buy a few lots on the RMO and a few lots on the moving averages and play around, because sometimes moving averages give an early indicator, sometimes RMO gives an early indicator. But it's important that you use both the studies together so that you are aware where the market momentum is going. Now, you know, if I take something like this on the silver also, it's the same thing. I think we have a little short of time. We just have a minute more. So if you can say more, you know, silver also. Now this silver, it's a very classic example. This is daily chart. There was a buy, okay, on the 734. This was hit here, but it has not reached its high. So we are still not on the buy zone, honestly, and it's still on the sideways. So right now, if someone asks me, you know, what need to be done, see, it's already my sell, since this buy was not hit, the high was not crossed. Okay, my sell, this sell is still continued. The sell which was here is still continued. So there is, the silver is very choppy. If you can see here, there was this is where the stop loss was hit, because this buy was confirmed and its high was breached. So this was the bar which again had the same stop loss, the same 9th November bar which we saw in the gold. So there was a stop loss here. Again, there was a buy hit here, but then the sell the high was not breached. The sell continued, and even the same year the sell is continued. So basically this sell is still continued. 23.60 sell is still continued. It had a low of 22, almost 1.60, and still it's still in the sell zone, it's still not in the buy zone. So that's it from me now, and hope you like my video, and if you need anything more assistance, please do contact me. Feel free to do it. Thank you so much. There are a lot of things to be done, to be there, so let's take it offline. Thank you so much.